Welcome to our YouTube channel where we provide valuable information about finance and investing. In today's video, we will be discussing the importance of diversification in investing and provide tips on how to create a well-balanced portfolio that includes stocks, bonds, and other assets. Set your investment goals. Before you start investing, it is important to set your investment goals and objectives. This will help you determine your risk tolerance, time horizon, and asset allocation. Your investment goals may vary depending on your life stage and financial situation. For example, if you are a young investor with a long time horizon, you may be more willing to take on risk and invest more heavily in stocks. If you are approaching retirement, you may want to reduce your risk exposure and invest more in bonds or other income-producing assets. Some common investment goals include building wealth for retirement, saving for a down payment on a home, funding a child's education, achieving financial independence. Allocate your assets. Once you have defined your investment goals, you can start to allocate your assets across different asset classes, such as stocks, bonds, and cash. The proportion of your assets allocated to each class will depend on your investment goals and risk tolerance. A common approach is to use the age rule, where you subtract your age from 100 and invest that percentage in stocks, with the remainder in bonds or cash. For example, if you are 30 years old, you would invest 70% of your portfolio in stocks and 30% in bonds or cash. As you get older, you may want to adjust this allocation to reduce your risk exposure. Consider different sectors and industries. Within each asset class, you can further diversify your portfolio by investing in different sectors and industries. This can help to reduce your exposure to any one industry or company and spread out your risk. For example, within the stock market, you may want to invest in companies in different sectors, such as healthcare, technology, and consumer goods. Within the bond market, you may want to invest in different types of bonds, such as corporate bonds, municipal bonds, or treasury bonds. Consider alternative assets. In addition to stocks and bonds, you can also consider alternative assets, such as real estate, commodities, and cryptocurrencies. These assets can provide additional diversification benefits and may have a low correlation with traditional assets. For example, real estate investment trusts, REITs, can provide exposure to the real estate market without the hassle of owning physical property. Commodities, such as gold or oil, can provide a hedge against inflation or geopolitical risks. Cryptocurrencies, such as Bitcoin or Ethereum, can provide exposure to a new and growing asset class. Rebalance your portfolio. Finally, it is important to regularly review and rebalance your portfolio to ensure that it remains diversified and aligned with your investment goals. This may involve selling or buying assets to maintain your target asset allocation. For example, if your stocks have performed well and now make up a higher percentage of your portfolio than your target allocation, you may want to sell some stocks and buy bonds to rebalance your portfolio. Rebalancing can help to reduce your risk exposure and ensure that your portfolio stays on track to meet your investment goals. Conclusion. In conclusion, building a diversified investment portfolio involves setting your investment goals, allocating your assets, considering different sectors and industries, considering alternative assets, and regularly rebalancing your portfolio. By following these steps, you can create a well-balanced and diversified portfolio that aligns with your investment goals and risk tolerance. Thank you for watching, and don't forget to subscribe to our channel for more valuable financial information.